All right, good afternoon, everyone. Welcome back, and thank you for attending our Investment Currents live event, which is our last live call in 2021. I am Chris Briscoe, Vice President and Wealth Advisor for Girard, and joining me once again is Girard's Chief Investment Officer, Tim Chubb. We're just over 3/4 through the year and have another great call lined up for you today, but we do have our usual housekeeping items. First, you're going to see some disclosures on the screen regarding forward-looking statements, how we reference Girard, so please take a minute to read through. And also just a reminder, the presentation is being recorded, so if you're not able to stay on for the duration of the call, or if you want to watch this again in the future, please go to our website, which is meetgirard.com. The replay of the presentation will most likely be available within the next week, but there's plenty of information on the site that you may find helpful and informative in the meantime. Also, as in past calls, we welcome you to send in any questions you may have. You'll see in the bottom right-hand corner, Q&A. All you have to do is click on the Q&A, and that will allow you to enter your question. All right, and with that, Tim, let's get started. Why don't I hand it over to you?
Awesome. Thank you, Chris, and good afternoon, everybody. Thanks for joining us on, as Chris mentioned, hard to believe our last call of the year. We can keep saying as we go through these, the quarters that keep getting shorter and shorter, and I think it's due to just the sheer volume of information that we've been contending with and economic data and otherwise as we go through the pandemic. But I hope everyone had a great summer and is doing very well ahead of the fall and holiday season. As has been typical, we'll start today with an update on market moves for the quarter in the last 3 months, and then provide a broad assessment of the fundamentals of the economy that we believe will be driving the returns in capital markets in the days, weeks, and quarters to come. And again, after the prepared slides, we'll open it up to questions, as Chris had mentioned. But again, before that, let's start with recapping performance in the markets last quarter, and then we'll dive into some thoughts on the pace of the economic recovery. We'll touch on some recent fiscal and monetary policy decisions, inflation, which I'm sure everyone wants to hear some more about, and a few notes on recent stock market volatility. So jumping into it, global markets moved to new highs again in the third quarter as investors look past the resurgence of COVID-19 cases here in the U.S. and around the globe, and instead focusing on the global economy returning to pre-pandemic levels and ongoing historic support from not just the Federal Reserve, but other global central banks. In late September, we saw a sell-off that brought the S&P 500 to a closing value of about 4,300, down about 5% from the most recent high on September 2nd. The recent downturn resulted in an overall flat return for the quarter, about 0.6%. Even with the middling returns for the quarter, the S&P 500 is still up nearly 16% on a year-to-date basis. And while the equity markets here in the U.S. were generally flat, we saw a pretty violent rotation within market styles, capitalization or size of companies, and sectors continuing underneath the surface. And so we'll get into this a little bit later, but the rotation back into growth stocks that began in the second quarter continued through the end of the third quarter. And in recent days and weeks, it's even reversed itself here as we start the fourth quarter. And this can be really evidenced by looking at the Russell 1000 Growth Index, which is similar to the S&P 500, but rather it being the largest 500 companies. It's the largest 1,000 businesses that are publicly traded here in the United States. That index was up 1.2% for the quarter, outperforming value stocks as measured by the Russell 1000 index, value index, which was down about 0.8% for the quarter. So about literally on the nose, 2% outperformance between the two styles. Small cap companies as measured by the Russell 2000 index were down 4.4%, significantly underperforming large cap stocks. And even with a flat equity market overall, 7 out of the 11 S&P 500 sectors had posted positive gains. But again, it was the cyclical sectors like industrials, materials, and energy that we really saw the sell-off take place in the 3 months prior. Overseas, developed markets also posted flat returns for the quarter, down about 0.4% as measured by the MSCI EAFE index, while emerging market stocks as measured by the MSCI Emerging Market Index significantly underperformed developed markets, down about 8% for the quarter. This decline was due in part by the investor reaction by the potential default of the Chinese property giant Evergreen, which is a titan in the Chinese property market, which I'm sure we'll get a question about. and the potential ripple effect that it could create through the country's property market. Getting to the bond market, return in the taxable bond market as measured by the Bloomberg Barclays Aggregate Bond Index was also flat for the quarter, really flat, up only about 0.1%. However, interest rates bounced around as the yield in the 10-year Treasury fell for most of the summer and then ended the quarter with a rapid rise, suggesting that bond prices could be headed lower in the near term, yields higher, bond prices yields higher. Inflation concerns and the Fed indicating that they may begin tapering their monthly bond purchases at the November meeting helped push rates higher as we ended the quarter, and that's continued here into the fourth quarter. The 10-year Treasury began at almost 1.5% at 1.45%, drifted lower to 1.19 in the beginning of August, and then bounced higher to end the quarter at 1.52%. So again, yields and prices move inversely, and overall a violent move in the bond market in a short period of time.
And Tim, you mentioned that the economy continues to rebound from the, we'll call it the pandemic-driven recession, but the road has been a bit bumpy recently as the Delta variant has put a dent again in industries like travel and entertainment. Let's start with your thoughts from a 10,000-foot view of GDP and the current state of the economy.
Sure. Yeah. So in the last several quarters, I think, in the last year and a half, any assessment of the economic environment and consequently the markets really has to start and end with the pandemic. And so, this chart that we'll show here, shows the 7-day moving average of new confirmed cases in the U.S. and around the globe. And after seeing cases fall sharply in the spring as the initial wave of Americans were vaccinated, daily cases rose to about 150,000 per day in early September, meaningfully rising after seeing the daily average slide to about 12,000 at the end of June. And so thankfully, cases have begun to peak recently. It's largely expected this trend will continue given more widespread immunity and prior infections. And it's now estimated that roughly 85% of the U.S. population has at least some immunity to the COVID-19 virus. And certainly while the pandemic is not over yet, I think many parts of the economy have adapted to operate in this pandemic environment. And whether we see it fade or not, I think it's fair to say that it'll be certainly less disruptive to not just the U.S. economy, but the global economy in the next 2 years as it was in the prior. And so, as I think I mentioned in prior calls and shared some slides in the past, the last economic expansion that we saw that started at the end of the global financial crisis was the longest in U.S. history. And this was following, and of course, then we had the deepest recession since World War II take place last year, with output falling by about 10% in the first half of the year. And so, thanks to the tremendous monetary and fiscal policy stimulus, output has certainly rebounded very, very quickly. Very much has been a V-shaped recovery. And now GDP, so the goods and services that our country produces, is now recovered to levels that we saw in the fourth quarter of 2019, and on track to return to trend growth in the 20 years preceding the pandemic. And so, while growth has certainly been slowing compared to year-over-year increases that we saw in the first and second quarter, economic growth continues to be strong both in absolute and relative terms. We expect the U.S. economy to fully recover from the pandemic as we enter the new year. As I mentioned, from a GDP perspective, it already has, but we haven't necessarily seen that full recovery take place in other areas such as the labor market. And I think as looking at the global economy and beyond the next few months, we're also expecting that the global economic environment, not just the U.S., may also be looking very favorable for investors. And the Organization of Economic Cooperation Development, or the OECD, forecasts every one of the 45 major economies will grow next year, but about half will experience slower growth than we saw in 2021. And so, just looking at year over year, global growth is expected to be near about 20%, or 6% in 2021. And wouldn't that be nice? And we'll decelerate slightly, to 5% next year. But and that's according to the IMF. But this is the fastest growth rate we've seen since 1973. It's the last time global growth was 6% or higher, and it's very rare to see global growth exceed 4% 2 years in a row, not 20% before. So
right. Well, let's stay on labor market for a second. The last quarter in September marked the end of the enhanced unemployment benefits, which seem to have a noticeable impact on labor force participation. What are your thoughts on the labor market as we're heading into the winter?
Yeah. As I guess briefly just mentioned, the surge in GDP has almost equaled, the rebound in the labor market, which really improved, pretty significantly last quarter in particular. And again, just to kind of take a trip down memory lane, and I promise I'll stop talking about this at some point. But the U.S. economy shed over 22 million jobs in February, March, and April of last year. And fortunately, we've recovered almost 80% through the last jobs report. At the end of August, we saw 77% of the jobs lost be recovered, or about 17 million. Busy day tomorrow. We'll get jobs report for September, and payrolls data look pretty strong from ADP today. And so, hopefully, we'll continue to see the labor market improve and the U.S. consumer remain on a very positive trajectory. Again, incomplete recovery, though. Unemployment rate is 5.2%. And we were at a generational low, about 3.5% before the pandemic, so a little bit of ways to go. The labor market has been slower, as you mentioned, and has been constrained by things like the extended or enhanced unemployment benefits. But there's also been the contention of lower rates of immigration, which the U.S. economy has been struggling with for years. We've had lingering fears about the pandemic and many American workers not feeling comfortable to re-enter the labor market. And of course, childcare has been very difficult. And so looking ahead, I think it's very important to watch just how quickly this labor market reaches full employment and gets closer to that 3.5–4% level. And members of the Federal Reserve Open Market Committee, or the Fed, or the FOMC, are estimating that the unemployment rate will reach about 4% by the end of next year. And it's a really important issue and a very important thing to watch, because ultimately a competitive labor market will drive higher wage growth, and in return, a greater likelihood for more sustained levels of higher inflation, as opposed to what I think we're going through right now, which I anticipate will be transitory, but perhaps a little longer transitory than we expected.
Yeah, and we'll get to that. Let's put a pin in inflation for 1 second, because I know we're hearing a lot of concerns from clients, and we want to spend some time on it. You mentioned the FOMC. What happened during the last Fed meeting at the end of September that might have started off all this volatility?
Sure, and I think it's important to start with just the goals of the Fed. As just a quick reminder, I know we've mentioned this on a couple calls, but ultimately the Fed is trying to accomplish two things. One is full employment. So typically an employment market where able-bodied Americans who want to be in the workforce can find a job. And full employment has, I guess, ambiguous definition, but I consider it somewhere around 4% or even lower. Some would argue even 4.5% would be considered closer to full employment. So we're really getting there much closer. Much more quickly, excuse me. The other objective is to have price stability, and so that's just a economist's way of saying keeping inflation close to the 2% target that the Fed has long mentioned is their inflation target, but it wasn't really until the global financial crisis where they really said it's 2%. It was sort of something behind closed doors prior to that, and so they have some policy tools that they can use to accomplish those two objectives. And the one that is most typical is raising and lowering short-term interest rates to achieve this reasonable amount of inflation in a healthy labor market. And so, when ultimately the economy is starting to weaken, the Fed can lower interest rates to help stimulate economy and borrowing and people spending money and companies spending money on CapEx. And once again, and then the other tool that they typically, or in the opposite, it's raising rates to curtail inflation and curtail growth because it may be getting out of control. And the other tool that they've used really since the global financial crisis in mass has been quantitative easing, or buying bonds, treasuries, mortgage-backed securities, ultimately to lower long-term interest rates. And they've been buying bonds to the tune of $120 billion per month to keep a lid on long-term rates since the beginning of the pandemic. And so, during the meeting at the, I think it was the third week of September, the FOMC did deliver a bit of a hawkish message. And participants recognized the Delta variant had slowed the pace of economic progress, but the labor market had significantly recovered, as we just discussed, and inflation may be a little bit more stickier than we previously expected. And so in their update, they provide a summary of economic projections, and the FOMC downgraded their growth estimate for the full year of 2021 from 7% to 5.9%, and revised their inflation estimates a bit higher, as well as reduce the speed of the labor market recovery that's expected by the end of the year. And so, while the Fed certainly remains optimistic, they did, shift to this more hawkish message on monetary policy. And as it stands right now, the participants of the committee are divided on whether we'll see a rate hike by the end of next year. But most importantly, the Fed also gave the first official signal that tapering the $120 billion per month in bond buying could soon be warranted, ultimately suggesting an announcement that will likely take place during the November meeting. And although Chairman Powell did not share during the press conference the exact timing and pace and composition, he did suggest that there is broad support for tapering amongst the committee members and that it would conclude towards the middle of next year. And so back of the napkin math, it's pretty simple, 120 billion, likely to be, something that will kick off near the end of next year. Many market participants are, thinking that'll be a monthly purchase pace decline of about $15 billion per month, and taper, symmetrically. And so I think as we look to next year, look at see how the committee is currently feeling about, the normalization of monetary policy. Ultimately, the speed of the labor market is extremely important. And while the Fed is certainly taking, their foot off the gas pedal, they're not yanking away the punch bowl, and policy is still extremely accommodative and will remain very accommodative for quite some time. And so I also want to mention that tightening of monetary policy is not just occurring here in the U.S. In the first week or second week of September, the European Central Bank also upgraded their growth outlook and responded to this positive development by announcing a more slow reduction in the pace of asset purchases as well, and a much slower pace than here in the United States. And so ultimately, I think the message is that the Fed is recognizing that inflation will be a bit more stickier and than anticipated, but ultimately committing to that transitory message. And the big news was that the Fed will likely start tapering their bond buying and announce that in November.
And I'm a Yankee fan, so to quote Yogi Berra, this is like deja vu all over again. And I bring up 2013 when Ben Bernanke, Federal Reserve Chairman, he commented that the Fed would begin to taper, and the market sold off.
Yeah, that was the so-called taper tantrum. That's right, and that taper tantrum was something that Fed Chair Jerome Powell explicitly said that he and other FOMC participants were trying to avoid. And so we saw a 5-day sell-off in the bond market, which was really swift and pretty violent. The 10-year Treasury during that period of time moved about 40 basis points or 0.4% higher to about 2.6%, and the S&P 500 declined 5% as a result. And so ultimately, this sell-off was temporary back in 2013. The S&P 500 returned about 32% that year after that initial panic. And that panic was very similar to today, where investors sold growth stocks for more cyclical companies. And then not long after the initial panic, they piled back into the former after their little summer tantrum.
Yeah, it seems that there are a lot of similarities between the two.
Yeah, and I think it starts with the bond market, and it's one of the things that we try to spend a lot of time through these presentations, helping connect the linkages between the real economy and how that feeds into interest rates, and how those interest rates, with the market being a discounting mechanism, ultimately, are impacting stock market valuations. And so, the challenge we've had is that really been a combination of very, very easy monetary policy, again, not just here in the United States, but really around the globe, and a severe recession that left the 10-year Treasury at very low levels. And so, despite this constant barrage of inflation headlines related to wages and consumer prices, the 10-year has only moved up to 1.52% recently. The bond market really hasn't gotten too excited. And while the move has been fairly significant in the short term, I think it's a move that in a normal environment where we were seeing growth in inflation at these levels, you would expect the bond market to be a little bit more cautious and price that higher rate of growth and inflation in a bit more. But the liquidity measures from the Fed to support this healthy bond market have ultimately compressed credit spreads, which is the compensation to lend money to a borrower that's not of pristine credit. And despite our woes searching for yield, international investors too have gobbled up treasuries, coming into the United States, buying bonds, driving their price up, which sends yields lower. And so, while raising rates is probably still a ways away, it could be a year, it could be more. The road to get to raising rates starts with the ending of quantitative easing, which again will likely take place by the middle of next year, sometime in summer. And so while I think rates moving higher is probably a 22 conversation about when in 23, it could change depending upon just how quickly that labor market snaps back, and if this inflation sticks around a little longer than the market participants and the FOMC are predicting. And so, again, as I mentioned, the chance of a rate hike by the end of next year is about 50%. I'd argue it's probably even a little bit lower than that. But we expect to see yields continue to grind higher. I don't think it's going to be necessarily the sprint like we've seen the last few weeks. Economic growth remains strong. Inflation risks remain higher than normal. And I think the bias of rates is certainly higher going into next year, which means it's extremely important to have a properly designed and positioned bond allocation, which typically is very sensitive to interest rate risk, especially on the long end of the curve. It's very important to consider other alternative asset classes beyond just traditional treasuries and very core-oriented bonds to provide some diversification and hedging benefits. And so, getting to the stock market, I know bonds are everyone's favorite subject. Higher rates, higher bond yields directly impact the market, as I mentioned earlier. We've seen investors sell stocks. We've seen selling pressure within growth stocks, which have outperformed value over the course of really the last market cycle, but also for the bulk of the summer. And earlier last quarter, the fears about the Delta variant, drove interest rates lower, as I mentioned earlier, allowed for growth to outperform, for the last couple of months. But it's really been value-oriented stocks that have, taken the lead again. And I think one of the most confusing things is that as interest rates rise and economic activity is above trend, value stocks or businesses that are more cyclical in nature tend to outperform growth stocks, which is very confusing because you'd think higher growth means growth stocks will outperform, but it's actually the opposite. Go figure. And the reason being is that cyclical, value-oriented companies are much more sensitive to the economic cycle, and they're sensitive to this explosion of growth to the upside and also the down. And when the pace of economic activity moderates or slows, investors are more comfortable paying the higher valuation that growth stocks carry for certainly, and they also are more comfortable paying for much more consistent growth. And so I think the most important takeaway is don't abandon growth stocks. Do not abandon bonds. It's an economy that is likely to slow down to a much slower pace next year and the year after. And I think that we could see, and we're seeing a bit today actually, a reversal of the recent changing of the guards that investors have may anticipate.
Yeah, and I'm going to move back to take a step back to inflation. The latest year-over-year gain in CPI is at 5.2% overall and 4% excluding food and energy. I've been saying transitory, but I've been hearing transitory for longer recently, as evidenced by the FOMC comments. What's the investment committee's take on inflation?
Sure. I mean, haven't you heard it enough from the media already? They have it all figured out, right? Just talking about those headline numbers, but that's what drives eyeballs, the news articles and into the TV screen. I'm kidding, but there's no doubt that inflation has definitely heated up significantly this year, as we've seen both surging consumer demand, which was a direct result from stimulus, and I think we showed personal income low earlier, where we saw personal income levels really accelerate as stimulus flowed through to the American consumer. But as that spending, took place and flowed through the economy, it was income that was coming back into the door every single week, every single month. And so we've seen things, moderate quite a bit. The other element has been supply chain. And, we've definitely seen, supply chain shortages across major sectors of the economy, again, here in the U.S. and globally. But I think it's important to keep in mind that, year-over-year gains have been amplified by price declines that took place as a result of the pandemic recession from 19 to 20. And, as we, let's say, anecdotally look at, ticket to Florida for, the winter, maybe, normally it costs $200. And last year, due to demand being low, the airline decided to lower the cost of that ticket to $150. And now it's back to $200, which was pre-pandemic levels. Well, that's a 33% increase flowing into the inflation data. And so, a lot of what I think is helpful is considering inflation data from today, looking back to 2019, and zooming out even more and looking at how meaningfully inflation had performed, compared to what the Fed was expecting over the last market cycle. And that's really some of the comments we've, heard from the Fed that, ultimately, these long run inflation expectations captured by the Fed's index of, common inflation, they're well anchored, and they've only just really reversed the last cycle's damaging decline. And Fed Chair Jerome Powell really downplayed, the measures of short-term inflation expectations, including the New York Fed's 3-year look-ahead measure. And so, one of the things I think it's important to know too is, CPI numbers are important, but the PCE, or personal consumption expenditures, is really the preferred measure of the Fed. And while that measure is up 4% year over year, which is quite a bit less, obviously about 20% less than CPI, it's still above the long-term target of 2%. And so, again, last month, Powell stuck with the strong message that high inflation will largely be transitory, and that, again, these inflation expectations remain well anchored. And so you start to see imaginations run wild a little bit. Again, I think a lot of this is just driven by just the sensitivity of American consumers towards, going to the supermarket and seeing meat prices be up pretty significantly. But the likelihood of stagflation or permanently higher inflation is still very, very low, full stop. It's very low. And so I think these supply chain disruptions will be ironed out. I think demand growth will cool with less stimulus sloshing around the economy. And I think supply chain disruptions are pushing inflation a little bit longer ahead, or excuse me, a little higher and longer than expected, but we do expect them to fade as we go into the new year and beyond.
Yeah. And beyond the Federal Reserve, it seems as though your team has been kind of predicting a pullback in the stock market for the last month or two. What else has you concerned, or what else had you concerned about markets?
Yeah, sure. So I think it's helpful to set the stage that equities made all-time highs all summer. Up until September, we continued to grind higher, melt higher. We saw a large period of time go by where there wasn't even a 1% move in either direction from the S&P 500 and other global indices. And that was despite this weakening economic backdrop where, we had this bad news is good news regime take place once again, which implies that, economic data slowing is met with, optimism from the market or optimism from investors, because they can rejoice in knowing that the global central banks will likely keep the easy money and the pace of accommodation the same. And so while stocks really shrugged off these downgrades to growth, we felt like it was only a matter of time before volatility picked up after the summer lull, especially ahead of a lot of this geopolitical uncertainty, which always concerns the market for a very short period of time before ultimately resuming higher. And so, again, despite the weaker data, also earnings continue to recover in a pretty spectacular fashion and are now expected to hit all-time highs this year. And that partly reflects, that some of the largest sectors within the market are technology and communication services. They make up about 40% of the S&P 500. These businesses, they saw very few negative impacts from the pandemic, and in a lot of cases saw stronger revenue growth as many Americans are sitting at home watching television and spending more time on their phones and social media. We saw revenue growth really accelerate. And again, these are some of the largest companies within the market. And so we've also seen, as I mentioned, consumer demand certainly bolster, earnings. We've also seen higher productivity levels from businesses as they've been able to reduce costs in a virtual environment. But ultimately, the markets are forward-looking. I think more forward-looking than maybe a lot of our clients or investors realize. And things might get harder for stocks despite a more favorable economic backdrop. Growth is slowing, wages are rising, interest rates are rising, demand is cooling, global supply chains are a mess, and we'll probably have a corporate tax increase. And so we felt like investors were being a bit complacent, and I think valuations, even despite the pullback, certainly look more attractive, and they have gotten more attractive because of earnings growth, because of the price decline, but it could be a bit of a speed limit as we go into the new year, just given where things are at.
And we were discussing this earlier this week, that going back to 1950, the S&P 500 has experienced, on average, 3 separate 5% pullbacks every year, and averaged about a 10% correction about every year as well. So I guess you could say we're kind of overdue for one.
Yeah, we were overdue. Again, as you mentioned, 5% pullback. I think it was the longest we hadn't had a 5% pullback eighth longest time that we hadn't had a 5% pullback going back to the 1930s. So despite seeing the market indices move higher for much of the summer, we started to see some signs underneath the surface of the market where breadth was weakening, despite, again, that index performance masking a lot of that chop. And, again, valuations are looking a bit more attractive after the sell-off. After all, there's two ways for companies to look less expensive. It's prices move down, P in the E equation, or E moves higher, right? And we've had both really take place this year where earnings growth has been significant. And so, as I mentioned before, I think, valuations still are elevated to some degree. I think, it's helpful to look in terms of, the market relative to, say, the bond market, for example. And if you were to compare, forward-looking earnings, forward-looking PE multiples of the S&P 500 compared to, say, the 10-year Treasury, we're actually only around like 34 percentile type of evaluation. Going back, I can't remember the exact date that went back over, but certainly, in the early 1900s. And so my point is, valuations have looked a bit stretched in certain areas within the market, especially given some of this evolving economic data. But in context and relative to bonds, they actually don't nearly look as expensive. And so it's helpful to look at things. It's really all relative. And so, I guess going back to an earlier question, we expect the global economy to continue to grow above trend next year. We expect robust earnings growth to be an important catalyst for international markets as well. And so, one of the things that's really important is diversification. Just because the S&P 500 is selling off, or because maybe an investor thinks that the S&P 500, has an unattractive valuation, doesn't necessarily mean there are not stocks underneath the surface or companies that compose that index that won't look attractive. And if you look outside the United States, both emerging markets and developed markets are at some of their cheapest levels that we've seen in the last 20 years. And so we've seen vaccination progress take place there. We've seen significant progress as far as, the economic activity picking up as a result of that vaccination rate, climbing higher, and a global post-pandemic economic rebound, lower trade tension probability, prospect of a lower dollar, which really helps many of those businesses. Ultimately creates a really compelling argument, I think, for international equities. And so, the last thing I'll mention, we're headed into a very, very important earnings season. Third quarter earnings season will kick off next Monday in earnest, ultimately with 47% of the companies by market cap in the S&P reporting during the week of October 25th. And about 86% of companies will have reported by November 6th. So the next 3 weeks in particular are going to be extremely important. Consensus estimates for S&P 500 growth are expected to be up about 27% year over year, with quite a bit of a sharp deceleration from what we saw in the second quarter, which is 88% growth year over year. Again, comparing it to the bottom of the pandemic, in March and April and May of last year. But ultimately, this growth has come from both margin expansion, meaning companies are more profitable, but also from top line sales growth as well. And so, I think the last thing I want to mention is we've kind of had a fairly low bar for earnings season last quarter. We may have a fairly low bar for earnings season this quarter, and that could push the indices back to the record highs by the end of the year. But it's going to be so critical to hear the commentary from leadership of these companies, how they're managing through a global economy still riddled by a pandemic. And I think corporate taxes are also presenting a risk as we head into year end. And while it's a moving target, it could impact S&P 500 earnings by about 5% next year through the proposed tax increases to corporations. So a lot of variables, again, a lot of noise in the economic data that's ultimately impacting corporate earnings and therefore impacting valuations and their prices.
Yeah. Well, at this point, I think maybe we should hit a couple questions that are out there. We had some that were given to us previously as well. So the first question we have, it's about the standoff in Washington around the debt ceiling, infrastructure bill. I think today they might have agreed to kick the can down the road until December, but can you give us some quick background and share how your team is thinking about this particular risk?
Sure. Yeah, debt ceiling resolution just a few hours ago. So that's certainly been good news, and I think propelled the market higher. If you looked at when the headline was announced, yesterday that they were getting close from Congress, and then the positive news today. And so again, from what I've seen, headline wise, it looks like about a $480 billion raised to the debt ceiling to carry the Treasury through December 3rd, at which point, again, kicking the count down the road, like you said, they'll have an additional debt limit increase or suspension that will be required at that time. The amount of $480 billion was actually higher than a lot of political strategists were anticipating that the Treasury would need to get to that date. And so actually there's a good chance that, the can will be kicked even further past December 3rd, which is, I suppose, positive news. But, the probably not efficient to last, sufficient to get us all the way through the end of the year. And I think the Congress will have to address this issue, sometime in December. It may not be the 3rd, but certainly by, the end of the year as part of either the next reconciliation bill, standalone bill, or part of the spending package for fiscal year 2022. To extend that spending authority, past its current expiration. And so, unfortunately, the theater around debt ceiling, the theater around the budget, usually is nothing but just that, drama, and it makes for great headlines. But it also, I think, underscores the logjam in Washington right now with, two other massive bills that really form the core of President Biden's economic agenda. One being the bipartisan infrastructure package, which includes, over $1 trillion for roads and bridges and public transit and broadband expansion. Then there's the even more complicated $3.5 trillion bill that focuses more on Medicare and climate change and boosting some of these social programs and social infrastructure. And so that bill includes, corporate and individual tax increases. Obviously, bogged down by a tussle between Democrats over size and scope. And I think we'll likely see the bill, significantly downsized to win the support of some of the moderates in the Senate and ultimately buckle up for, more negotiations over the course of the month of October. But, one of the most hard or difficult things to estimate is tax increases because things change so many times. The current bill would take the top individual rate back up to 39.6%. They're also suggesting a new surtax on income over $5 million. We've heard for an increase of the capital gains rate for wealthier taxpayers and the reduction of the amount of inherited assets that are exempt from estate tax, among other things. And so I think the most important thing is details are likely to change and not likely, but almost guaranteed to change as the bill inches its way, day by day, week by week through the legislative process in the weeks ahead. And it's really difficult, I think, to make dramatic, not that we ever encourage this, portfolio changes until there's more clarity around what final legislation may look like. And so, keep in touch with your advisor, keep in touch with your tax expert about potential implications for your situation. But ultimately, it's very difficult to predict just what ultimately will come into the bill and just how ultimately it'll impact, your personal tax and income situation.
Yeah. Next question we have, it's a couple clients have brought this up as well. I'll paraphrase. It's about the Chinese property developer Evergreen and this potential default. What effects do you think it may have on the U.S. economy and individual companies that do business in China?
Sure. Yeah, and I think ultimately it was September. I think it was around middle to end September where they had missed that Thursday payment, the interest payment they were expected to make on a bond. But this really began earlier in the summer, and I think the media really made it seem like it was this unexpected event that really wasn't being priced into the markets at all. Whereas actually that isn't really the case at all. But I guess let's start with the basics as far as who China Evergreen is, and ultimately give you some context perhaps on just how this has evolved since early summer. But China Evergreen is the second largest property developer in China. They sell apartments mostly to upper and middle income buyers, and over the years it's evolved in much more of a conglomerate with operations in sectors like autos and healthcare and media and finance. And the reason that, again, it's been dominating the headlines is that they're the most indebted property developer in the world with over $300 billion US in outstanding liabilities, and concerns about the company's ability to make payments on these upcoming loans and bonds, is definitely become heightened. And so it wouldn't be as much of a problem if Chinese property developers, state-owned enterprises, local governments, and even ordinary Chinese households didn't already have excessively high levels of debt And because the Chinese economy has been plagued for quite a while, these debt problems are really a moral hazard, and the situation is quite difficult for regulators to potentially sort out. But again, contrary to what the reaction in the markets to a degree, but really the reaction within the media, this wasn't news that just happened to emerge over the weekend. It's been something that investors and markets have known about the company's struggles for months. It's been reflected in share price, which has been pretty much in free fall since March of 2021. And bond investors weren't caught off guard either. The bond that they did not make the coupon payment for, that actually was coming due that September 23rd, I believe. It basically plummeted to 24 cents on the dollar right after they made that announcement. And we had seen 2025 debt that they had also have outstanding trade through 50. So if it's a par of $1,000 per bond, it was down to 500, right? Again, market pricing in some of that default risk. And so I guess the big question, I suppose, is what's the financial risk, given that we have these 300 billion US in outstanding liabilities, but ultimately what does that represent as a percentage of the total loan balance of Chinese banks? And it's about 0.3%. The big number, as I mentioned, it's this 300 billion, which is 2 trillion RMB. Certainly not small, but it only accounts for a small amount in financial securities, which only is about 88 billion, which is less than 0.1% of sector loans, and less than 0.04% of all onshore bonds. And so I guess what I'm trying to say is it's not systemic by looking at those large levels of debt because of how large how much debt exists within China and how spread around that it ultimately is. But contagion certainly gets the clicks, and I just don't think that there's conditions for a sweeping contagion event. And so ultimately the real risk, I guess, from my perspective, and I'm certainly not the expert on China, but it's been something I've been researching quite a bit over the years, and I've read some wonderful books if anyone's interested in a recommendation. But of the 2 trillion that everyone's panicking over, half is tied up in trade payables and acceptance bills, and so these are basically loans extended by suppliers and contractors. And so if Evergreen were to build a housing unit, they might finance some of that construction with materials with suppliers for the next 12 months. And that's really where the dominoes could start to fall if the Chinese Communist Party lets this unravel. And those trade payables are tied up in 8,000 upstream and downstream construction partners. And so defaulting would distress these partners, obviously. It would distress Chinese citizens who have already placed deposits on the apartments and homes that Evergreen is building for them, which I believe is around 2 million undelivered contract sales, and so quite a few upset Chinese citizens. And so again, I'm no expert, but I think the one thing that China is very afraid of is being overthrown. We saw that start to percolate in Hong Kong at the middle and end of 2019. And how does someone get overthrown? Social unrest. How do you get social unrest? Tell 8,000 construction partners they're not getting paid. Tell 2 million people that they're not getting the homes they put down payments on. Tell 70,000 people who purchased wealth management products through Evergreen that their investments are worthless. And so I think an outright bankruptcy of Evergreen would ultimately lead to widespread social unrest. That's where the contagion lies, not in the financial system, but more so in the social fabric. And so I don't think this is a Lehman event. Not at all. But the bottom line is, I think Evergreen may be the sacrificial lamb, and set the example, let them feel the pain, keep the risks ring fenced, deliver a message. Mind your leverage, mind your debt. Banks are in control, and circumventing the system will not be tolerated. And so again, it's not something that we're taking lightly. We're watching very closely, but I do not think it's going to be a Lehman contagion event, and I do think there's more potential second and third level consequences related to the fabric of China that are a bit more important than just the debt.
So no deja vu all over again, we hope.
I don't think so.
Next question is, you touched on it earlier, the supply chain, but what is your take on the current state of the supply chain and how it may impact the markets?
Sure. Yeah, I mean, the supply chain problems mean risk to corporate sales and, manufacturing production. It also means that consumer inflation, stays higher for longer. And, despite this information, though, as I mentioned earlier, analysts have been rapidly increasing their earnings per share forecast for companies in recent months after second quarter estimates have really exceeded expectations by quite a bit. And so, these sharp, increases that the forecasts have been ultimately supporting high stock valuations, but as growth momentum slows and risks rise, such as supply chain issues, stocks could also continue to be vulnerable. And so I think it's something very important to keep an eye on as the year closes out. I saw a report recently, really interesting. I mean, I can get into trying to remember some of the data related to just the price of a shipping container and how much that's increased. It's been quite a bit, but the number of containers, container ships, I should say, has risen fourfold at anchor, just waiting in San Pedro Bay and outside of Los Angeles and Long Beach. And after it dropped to about, I think it was around 10 in June, the number of ships is now back up to 40. And so, most are coming from China. Apparently, that's where a couch that I ordered, I think back in February or March is. But, ultimately, after taking 14 days to cross the Pacific Ocean, you're looking at sitting in the San Pedro Bay for a couple of weeks while, there's not enough workers, not enough really the capacity to be put on trucks. And so, again, corporate earnings season is coming. I think listening to corporate earnings calls is going to be very important. We saw sentiment, towards the shortages really start to improve over much of summer. While growth was weakening, we did see, shortages really start to significantly alleviate in a relatively short period of time. Just like we've seen, this explosion in bottlenecks take place within the supply chain, really accelerate in a short period of time. It's only been about 4 or 5 weeks where we've seen, this rapid rise. And a lot of that's due to the holiday shopping season coming, really, very quickly. And so, looking at how things were last year, November 6th was the big deadline for many companies to put their orders in, prior to, to make sure that they were here for the holiday season. And so I think over the next couple of weeks, it's going to be something that will really dominate the headlines. But we may also see things like Costco, and just recently it was announced where they literally are taking matters into their own hands with a container ship and trying to get these goods, ultimately offloaded and into their stores. And so I think the most important thing, things improved very quickly this summer. Things deteriorated very quickly this, the last month or so. We may, hear quite a bit of rumbling in the next couple of weeks, but we do think it's ultimately going to be alleviated. There's no other way, right? This is going to be something I think that we'll be looking past, early next year. And we should hear more, with earnings season kicking off in full swing next Monday, although earnings season starts with the banks next Monday. I don't think we'll hear too much about supply chain from them, but as the quarter continues.
Well, personally, I'm hoping for a stressful-free holiday season. So maybe if people aren't going out stressing out about buying things, that'll make for a better season. Another question, where are you seeing value within fixed income with rates low, inflation expectation high, and equities in historical highs? Where should we look for safety?
Yeah, that's a great question. It's one that, our team, and so our investment committee of 7, we have, subcommittees that are really charged with bringing best ideas and thought leadership ultimately to that investment committee. And so we have a macro and asset allocation team that I sit on, actually, that's chaired by our colleague, Barry Keck. And it's been something we've been talking about a lot, really, for the bulk of the summer. We've seen credit spreads grind lower. We've seen it become very difficult to find value within fixed income. As I see it, emerging market debt has a lot of opportunity right now. That's something that we do not allocate to directly, but if you as a client have allocation to some of the funds that we've selected for you, and then you do have some EM debt exposure, and some of those managers have been taking advantage of an opportunity there. But ultimately, it's been a very difficult environment. And with fixed income, there's really 2 risks to be considerate of, 2 major risks. One is credit risk, as I mentioned earlier, or the ability for a company or a person or a government to pay back that debt. And the other is interest rate risk, which is the risk that exists if, let's say the 10-year as it stands today is 1.5%, and rates rise as the economy grows in the next 3 or 4 years and new debt is being issued at higher rates, well, who's going to want the old debt at lower rates? Well, the price has to decline to offset that and make things equal from a compensation perspective. And so right now, as we look at our portfolios, we think it's very important to keep duration low, or the average period of time that a bond will be paid back to, from the borrower. And also credit risk, and introducing more of that into the portfolio, even with spreads at very close to the record lows. Ultimately, I think continue to deserve a piece of the portfolio, albeit we're considering taking some money off the table there, and it could be just a clipping the coupon environment. And so typically in a situation where rates are rising, asset classes like high yield bonds, bank loans, short-term bonds help provide some nice hedge against interest rate risks, and they also carry a higher level of income generation as well. But as maybe concern starts to percolate around, and I'm not suggesting this is going to be the case next year, but towards the end of the economic cycle, credit risks become more important. Interest rate risk becomes less important, and so the opposite, rebalancing needs to happen. So hopefully that helped. But I find it much more difficult to invest not invest in fixed income, but to find value in fixed income right now relative to the equity market. I think we're looking at quite a few opportunities as a result of this sell-off that we think are pretty attractive, but the bond market hasn't budged. And many investors say the bond market's the smart money, and we haven't seen the bond market really get concerned at all over the news from the Fed. The sell-off took place, but as far as credit spreads are concerned, where we would really have a problem for economic activity continuing at this pace, has been non-existent. So.
Yeah, and I should mention too, you and I did a piece on fixed income and its role in a portfolio, which is on the website. So take a look. With that, I think we're going to wrap up the call a little early today. We do appreciate you taking the time to join. We thank you for your questions that were submitted, and we hope you continue to find this helpful and informative. Like I said, there's a lot of good content, so be sure to visit our website, meetgirard.com. And until next time, please stay safe, stay healthy, and let us know if we can help in any way. Take care, everyone. Thanks for joining.